Every year, specific illicit networks like cybercrime and the illegal wildlife trade generate hundreds of billions of dollars in capital. In 2021 alone, illicit transactions using cryptocurrencies reached an estimated $14 billion. Even in an era of hyper-monitored, digitized global banking, this illicit wealth continues to move through the economy with extreme efficiency. The mechanical goal of money laundering is the mathematical and legal severance of illicit capital from its source. Execution of this severance relies on a three-stage architectural framework: placement, layering, and integration. Placement introduces dirty money into the financial system. Layering obscures the audit trail through complex transactions. And integration reintroduces the capital into the legitimate market as untainted property. This process operates as an exploit of the global financial system's reliance on promissory law and standardized accounting. Detection risk is at its peak during placement. This is the stage where raw, physical cash must be introduced into a regulated digital bank. To catch these entries, global financial institutions use automated reporting thresholds, which trigger an alert for any cash deposit exceeding $10,000. To bypass these triggers, launderers employ structuring, a technique often referred to as smurfing. A large volume of currency is shattered into hundreds of small, separate fragments. These fragments are dispersed among individual smurfs who deposit them into different accounts at different banks simultaneously. Because each deposit remains below the threshold, the automated alarm never sounds, and the funds pool safely into a centralized offshore account. While smurfing successfully digitizes the capital, the money is still dangerously close to its criminal point origin. Placement serves only to move the liability into the system. To truly sanitize the capital, actors must proceed to the next phase to erase its history. Layering is the active camouflage of the source of funds through a labyrinth of untraceable transactions. The ancient Hawala system, an informal value transfer network native to South Asia and the Middle East, provides the template for analog layering. Hawala functions on a specific mechanical rule: no promissory instrument, no checks, no wire transfers, and no SWIFT codes are ever exchanged between brokers. A sender gives cash to a Hawaladar, generating a unique passcode. They contact a destination counterpart, transmitting only this code. The receiver gives the password to the second broker, who pays out the value from local reserves. To settle their ledgers without banks, brokers balance debts through shipments of physical trade goods, like gold or electronics. Standard regulators find Hawala nearly impossible to track because digitally and legally, no cross-border transaction ever took place. Virtual digital assets act as the modern equivalent of this trust network. Cryptocurrency provides a high-tech platform for the same logic of informal transfer. Blockchains are public ledgers, but their pseudonymous nature provides an inherent layer of protection for illicit movement. Digital layering uses tumblers. They pool funds, scramble data, and redistribute capital, making tracing outputs to specific inputs impossible. Funds then chain hop across different cryptocurrency protocols, leaving disconnected digital dead ends. Cryptographic mathematics are being used to achieve the same result as Hawala: the total removal of a financial footprint. Integration is the final phase, where layered capital is reintroduced into the mainstream economy as legal, taxable income. The primary tool here is the shell company, an entity with no active business operations. Fake invoices for non-existent services provide the documented legal justification for the sudden appearance of wealth. Launderers must eventually convert digital credits back into fiat currency to purchase tangible assets. They must materialize digital hashes into physical real estate. Integration is the operational choke point. If regulators prove a shell company is a phantom, the entire three-stage architecture is exposed. Localized law enforcement often fails to interrupt these cycles. Most domestic laws are predicate offense-oriented, meaning investigators must prove the initial crime, such as drug trafficking, before they can prosecute the money movement. This is a difficult task when the layering occurs across dozens of different jurisdictions. Global regulation shifted after the September 11th attacks, as tracking informal value networks became an urgent requirement for national security. This led to the empowerment of the Financial Action Task Force, which coordinates with domestic bodies like India's RBI to harmonize global financial oversight. Current regulatory authority stops at the same national borders where the illicit layering begins, allowing launderers to use national sovereignty as a physical shield for their transactions. To counter the integration phase, India's 2023 amendments to the Prevention of Money Laundering Act target the mechanics of corporate anonymity. The focus is on beneficial ownership, the legal requirement to identify the actual human being who ultimately controls and profits from a shell company. These new rules tighten the standard for reporting entities, lowering the beneficial ownership threshold from 25% down to just 10%. This forces crypto exchanges, NGOs, and intermediaries to look past corporate masks. They are now legally required to report the specific individuals at the center of the structure directly to the Financial Intelligence Unit. The primary battlefield is no longer just mathematical algorithms, it is data transparency. Financial obfuscation relies on fragmented information. Defeating it requires transnational data sharing that forces the actual architects of illicit capital out of the shadows and onto the ledger.